Hey, hi guys, welcome to the Quant Lab. The Quant Lab में आपका स्वागत है. In this video, we will talk about decoding strategies. The intent here is that I want to walk through the entire journey of taking a strategy. We'll take pair trading as an example, simulating it in Excel sheet, and then coding our way through Python, and then eventually backtesting using Python. We'll talk about the core concepts that you need to probably understand, statistical concepts, how to get data and stuff like that in Excel, because it's relatively easier to do that in Excel. And once we have, established what the core idea of a strategy is and measured it, let's say by just looking at returns and stuff like that, we'll then take this concept and code our way through in Python completely. So this is a new series. Think of it like decoding strategies. A lot of people ask me and want to validate the code. So this will do an end-to-end walkthrough, which is taking data. We'll also do that in Excel and Python, coding our way through strategy. We'll do that in both places. We'll do probably some portfolio evaluation and strategy returns calculation in Excel. However, in Python, we are going to extend this conversation. We'll do backtesting, we'll do forward testing, and we'll also do some risk analysis. So this series might go a little long, so might be 3 to 4 part conversation, but the intent is that I walk through end to end of a strategy process. Let's not wait and get started. And co-integration is a statistical relationship between two time series, essentially in this case stock prices, that are correlated and move together over a long term. So there could be small divergence, which could be caused by, simple run dynamics, volatility. So things like short-term fluctuation. However, the idea is that in a longer trend, they move together. So think of prices of gold and silver over a longer period of time, and they usually tandem along. However, there could be differences when we look at it from a day-to-day perspective. So we'll talk about co-integration and correlation a bit. All right. So what we have is, we have three different, this is a good article. I just picked it off the internet, and so we'll look at three different charts. So this is strong correlation and no co-integration. We can clearly see that there is some kind of, correlation here because they are moving in the same direction. However, they are not, the difference between them is widening. So this is a good example of strong correlation but no co-integration. This is a great example of correlation and strong, both of them. So both of them are strong correlation and co-integration. If you just add a little bit phase shift, so there's no correlation in this, but co-integration happening. Now, how do we define correlation? And correlation is essentially a statistical measure that indicates the extent to which two variables or time series, essentially stock prices, move in relation to each other. Their coefficients range from -1 to +1, and a value of 0 typically means that no relationship exists. If it's, towards the end, like -1 or +1, it does indicate that there's a perfect linear relationship. And if there's a positive correlation, it would imply that the other moves in the same direction. If there's negative correlation, it would imply that it moves in the opposite direction. Now, a bumper sticker here is correlation does not imply causality. Just because two variables are correlated does not necessarily mean change in one causes change in another. This is usually measured by Pearson's coefficient, and essentially it's a quantification of the degree of the linear relationship. So for context of a co-integrated time series, so we think about two time series or two stock prices are correlated in the long run, implying long-term equilibrium, even if short-term dynamics differ and there could be a weak correlation during some time period. All right, let's also now try to look at 2-3 different data points. What do we mean by run dynamics, right? So when there's a stock market, there are short-term fluctuations or movement in a time series, specifically for stock prices. Now, this could be caused by sentiments, this could be caused by market volatility, this could be just regular ups and downs. So this is run dynamics in quant term. A long-term equilibrium is, when there's a very balanced relationship, irrespective of the run dynamics, right? So that's a long-term equilibrium. And what I'll do is I'll just quickly show a good example on the screen to show the data. So what I have is the data for State Bank of India and Axis Bank and ICICI Bank. And I'll walk through the process of how I have captured all this data, etc., etc. So as you can very clearly see that if we consider 1 year as a long-term period, really those two are moving very nicely hand in hand. So Axis Bank is moving along with ICICI Bank, at least for the past year. If I for some reason change it to, a similar finance stock, which is SBIN and ICICI Bank, you will see very different trends. ICICI Bank has had some sort of a different, sorry, I don't know why this saying is SBIN. This is actually HDFC. It should update itself. Probably some bugs. But if you see HDFC Bank has had more, just by look of it, more volatility, and we'll not worry about the portfolio value chart and all of that. So what I'm trying to say is this is a good example of long-term equilibrium. Probably we can look at something which is just not even related in this space. So if you see Nestle India and ICICI Bank, completely, different tangents. I wouldn't consider them to be in equilibrium, and one of them is in some sort of a peak trend, which is Nestle, had a small downward trend towards part of the year, but essentially it's in a peak trend. Let's just, there's no way to refresh it. Oh, I don't know how to refresh in here. Nevertheless, it's updating the chart, so I'm fine. So yeah, that's the idea that we are trying to demonstrate. Another key statistical term that we need to be aware about is called stationary. So a stationary time series is basically that fluctuates around a constant mean and variance, and it tends to reverts to its mean after any fluctuation. Now this is very important and might sound very similar to mean reverting strategies, which pair trading strategy is. So now going to the strategy part of it, what's the strategy that we are taking a look? So co-integration strategies typically involve selecting a pair of related stocks. It could be in the same domain, or you have done your assessment, doesn't really matter. And the idea is that the prices are following a long-term equilibrium. If one price deviates, you can trade on the expectation it will revert. So that's the idea. So you think about, you long one and short the other. That's essentially the key, right? Also called as sister stocks and stuff like that. So, all right. So that's enough theory. Let's move on to the sheet and let's move on to, doing assessment. So what I've done is I've created two sheets. One is called data and the other is called worksheet. I'll first walk through what is the data sheet. Now in data, what I've done is I've taken entire Nifty 50 and all the stocks inside them, and I've just listed them through, just put it here basically in the first column A. And I'm using Google Finance to get the data. It's relatively easy. Otherwise I would have to download and paste and etc. etc. But I thought that the process should be automated in the spirit of algo trading. So I've tried to do that. So you have a simple formula. You can just put Google Finance, the market, the index name and the ticker price, and then all the parameters that you want. Essentially, this is a simple one, which is what I'm using. So what I've done is I have created data here and I've created 3 columns here. All of these columns are essentially just, you can do format and go to data validation, add rules, and essentially the criteria is drop down from range, and you select the range, which is basically the range is the, all of this data. So you just make that selection. As you can see, A1 to 51, that's the range, and it will just auto populate all of that. So all of this becomes drop down and really easy for me to operate upon. Now what I've done is I've just prepared 3 different columns or 3 sets of columns essentially. What each of them is doing is it's providing values for each of the columns. First B1, which is Nifty 50, C1, which is it could be whatever because it's a drop down, and then D. So what I've done is just captured the formula Google Finance NSCs to selected the worksheet and selected the price, and today minus 365. I can change this to any number of days for doing assessment. I think it does allow a little bit faster time window also, though I have not personally tried it. You can get a lot more data if you want, just to do your assessment. And then finally, all I've done is I've just associated these values in the data sheet. So that's how I have it. I can change anything and it will just auto refresh it, and that's pretty much what we're doing. Now let's go to the core part of the conversation, which is how do we do the strategy bit. So what I have done is I have captured two parameters. One is the slope and the other is the intercept. And the idea here is, as I said, co-integration is basically seeing that if they are moving along. So what I want to do is essentially just represent them as a linear relationship, simple OLS regression. That's what is being tried here. So I've calculated the slope using slope method, and I have calculated the intercept by taking average and subtracted both of them. So basically the average slope, so basically slope into intercept. Sorry, slope into the average of all of this. So this is the first column, which is C, and then this is the second column, C and D, and that's what is mentioned here. Okay, so that's the column co-integration. Now what I've done is I have taken the formula for co-integration and applied here. So essentially it's just going to be represented as a linear relationship, and all it's changing is depending on whatever is the value for C, it's just moving forward. Then I have X, which is just a delta between the co-integration. So think of, co-integration as, a midline. Think of it as a central line along with it is moving. There's other ways to do that, not essentially mean, but you could do this using z-scores, which I'll talk about probably in later videos in the same series. But essentially this is just, trying to calculate how far it is, basically the spread. So this is co-integration minus the second price, and you get some sort of value of X. Then you start to take delta, which is difference between F3, yes, F3 minus, it should be F3 minus F2, yes. And then you take a lag and finally go on to calculate returns for both of them. So which is C and D, these two columns. So the return for first, which is just take a difference, and then the return for second, take a difference. And eventually trying to calculate a strategy return, which is simply based upon the fact that if the column F is, where's F2? One second. Yes. So if this value, which is the delta, which is the difference, is greater than 0, you do J3 minus I3, which is the return, ICICI minus Grasim in this case. So stock B minus stock A, otherwise stock A minus B. That's essentially the strategy. And you calculate the returns, you sum them up, and then you finally take a portfolio value, start with simple 100 and see how it's moving forward. Just calculate it through for getting a portfolio value, and a market return is nothing here, but just looking at if you would have bought Nifty 50, what would have happened in this case. All right, so that's what is this about. It would be interesting to see all three of them together, because one of them is not moving, so I'll just put a new chart. Oh no, bad idea. Okay, it's terrible idea because it's Nifty 50 is skewing a bit. All right, never mind, ignore that. So that's how I have used, and that's basically the strategy. So let's see what is the total return over this time period. Now this is a bad stock. I think we were not intending to select it. One good part about this sheet is that you can just select drop down, it'll auto update everything in a second, and then you'll see. So here, if you see, this is giving a good return, which is 24.93, and you can see that we end up somewhere about into 124. So if I would have started with 100 rupees, I would have ended with 124, and that's just a trivial thing. You can change it to 1000 or whatever is it that you want. The percentage wouldn't change. All right, so that's essentially the strategy for pair trading. What we have done is established a stock, found out a way to see how something is trending long term, or going in a long equilibrium, and then trying to build a strategy using this. This is a really popular strategy, and a lot of people want to trade using this. You can do variations of this, Again, none of these are recommendations. It's purely to understand the academic side of it and to try it out if you intend to. Now there's few more things that can be done. Co-integration, the OLS is probably not the best way. We could do a little bit of optimizations here, which I'll talk about in my Python video. So this is just for a fundamental suggestion. All right, so that's summing it up. So that's the key conversation around pair trading. This was most likely a part 1 in the conversation because I've just realized that this video has gone bigger. You were watching Akash. If you have not subscribed, please do share the video. Thank you. Bye-bye.